morning, Jason. It is, let's timestamp this. It's April 10th. Jon Rahm is the latest golfer to don the green jacket. And we are getting together this morning to kind of recap first couple months of 2022.
Yeah, obviously we're wearing the green golf tie for Masters champion 2023, Jon Rahm. Came from 4 down to win, and I think there's an investing lesson in there about staying the course and kind of taking what the course is giving you and not getting overexcited or underexcited, right? No peaks, no valleys, which will be kind of featured prominently in a quarterly letter. But I think what Jon did was so impressive is that he kept playing his game, wasn't so much focused on what Brooks Koepka and the other golfers around him were doing. Stayed really focused and got the outcome that he wanted, right? Which he's walked away with the green jacket. And I think that for all of us that either you love golf or you're looking for an analogy to try to make sense of what's going on in the market, I think Jon provided that for us.
So it seems since we've been doing these videos, there's never a shortage of things to talk about. Every 3 months we get together and kind of look back on the quarter. This quarter is no different, right? We had the second largest bank failure in history, a lot of uncertainty, and yet markets continued to plow ahead for the most part. But maybe first off, let's go to what we've been talking about with clients. Everybody's been asking, and you highlight in the quarterly letter, for the first time in basically a decade and a half, it actually pays to pay attention where your cash is, right? That seems like the natural jumping off point, because for the first time, and you go into a little bit more detail in the letter, but look, we haven't been able to talk about clients about cash and CDs, money markets, U.S. Treasuries, things that generally have very safe principal protection, but are actually kicking off yield now.
Yeah, it's crazy. The last time that yields were this high, Dave, you and I were in Chicago, and Dave and I kind of go way back. A mutual friend of both of ours kind of connected us way back when, and you have to go back that far to find yields that are this good. Back when we were in Chicago in 2005 and 2006, you're opening up a checking account as a freshly minted Ohio State grad, and for me a Mercyhurst College grad. And Bank of America, at least for me, was paying me 5% in my checking account, not savings, not in the CD, just 5%, just for having my cash there. The little balances that I wasn't, spending prolifically, enjoying being young and dumb in Chicago. But I think it's important, and I think for us, and I write about this, is you take a poll of not only is it just new for us, right, as advisors 15 years ago, but for a lot of our colleagues. And I took a poll in an investment meeting like a couple weeks ago, and I polled some of our younger colleagues and just said, like, how old were you in 2005? And I got back responses like 4, 7, 11, and 11. I mean, it just goes to show you that there's a couple different kind of groups, right? Like a generation of people that just have never seen their cash earn anything. And it didn't, and you point out, and I think that your point to start this off was the right point, which was it didn't matter if you had your money in a checking account, a savings account, a T-bill, a purchase money market account, a certificate of deposit. It just didn't matter, right? You're making the same amount of money. And you didn't really have to worry about where your money was, right? Especially, post the great financial crisis with Dodd-Frank, severely restricted what banks could do. The banks that survived and got through, they got bigger and they got safer, right, through regulation, or so we thought. And I think for the most part they did, right? I think for the most part most banks are safe and our investor deposits are in good shape. But I do think when you sit down and you talk to clients, they don't want to talk about international, which we'll talk about a little later, being up a little bit over 8% to start the quarter, or the strength of U.S. equities. They want to talk to you about cash. They want to talk to you about what do you think that they should do with cash, and we've got some, we put out some articles on it. We're going to do a video later that discusses some options for cash, but it's been the story of the first quarter. It just cash yields and where to put it and how much you can earn, because there's a real opportunity cost out there if you just leave your cash laying in some kind of instrument that's yielding, a couple basis points.
Yep. I mean, I was looking at yields this morning before we jumped on this video, but I'm going to mention Schwab because we do business with Schwab, but Fidelity, Vanguard. I mean, not trying to just talk about Schwab, but I mean, you can go buy a money market right now and confidently, north of 4.5%, let alone if you go dip your toe on the short end of the U.S. Treasury curve, maybe go out 6 months, and I think I'm looking at 4.9%. I mean, in light of what is always going to be, well, maybe not always, but stock market's always been volatile over short periods of time. Now, I think, to your point, the last 3 years have been especially volatile. COVID, war in Ukraine, inflation, increasing global tension between the two largest global powers, right? The U.S. and China. I mean, there's plenty of things to kind of get concerned about, but it is compelling to at least evaluate clipping coupons at the short end of the curve, 4.5%, 5%, especially if it's cash you don't need in the immediate future.
Well, yeah, and I think that it goes to your point of when we're talking about how much stocks and bonds and real assets, and to the extent that you have a portfolio or a balance sheet that can handle it, and a risk tolerance that can handle it, kind of private market investments, right? Real estate, private equity, infrastructure, et cetera. We're always talking about what's the equity risk premium, right? What are we going to earn that's going to compel you to get out of cash? And for the last 15 years, there was the acronym, right? TINA. There is no alternative, right, to stocks, because you did have all of these instruments were yielding nothing, right? They're yielding 0 or certainly less than 1%. So that there was the incentive to go out and earn more because, well, you didn't have another option. And I think for investors now, you do have an option, right? You have to evaluate: are you getting properly compensated for taking risk when you can earn 5%? And again, this is on an annualized basis. So when you see us talking about treasury bills or CDs and they're less than a year, so these maturities, whether they're 3 months or 6 months or 9 months, when we're quoting you the yields, that's on an annualized basis, right? So, but if you can earn on an annualized basis, 5%, I think that over 6 month period, you got to really take a look at: are the valuations of stocks, or the growth prospects, is the macro backdrop? And I think that has made retail investors and some institutional investors a little bit more cautious, because they have an alternative now. They have seen the market become more volatile in a way that the previous 15 years we didn't experience that volatility. And I know that, Dave, we've taped a couple of these videos, over the last several quarters, where we'll have a bout of volatility, and you and I are always saying this is normal. Stocks being down 10% in a quarter used to happen all the time, and it's the reason that you get compensated, right? You earn more keeping your money in stocks over time because you have to withstand this volatility, right? That's the premium you get for pushing your money out on the risk curve. I think that a lot of investors, though, were conditioned, well, this volatility thing, we don't, it's not real, right? The Fed will come in and save us, right? That infamous Fed put, the first sign of danger, the Fed's going to come in and cut rates or do something accommodative to get the economy back going. And the Fed is not doing that, right? They've been steadfast. They raised rates last meeting in March or in early April, when a lot of people were clamoring in lieu of the bank failure of Silicon Valley Bank and Signature Bank in New York, that they shouldn't raise rates. But they kept raising them, right? Because they're really focused on inflation. And this higher rates for longer is going to create more volatility. At least that's our baseline assumption. And so if you're an investor that's not really used to volatility, 5% in the 6-month, 4.9% in a U.S. Treasury bill, that doesn't sound so bad. And I think that you're going to have this push-pull dynamic for the first time in a decade and a half, where investors are going to say, you know what, I'm good earning 5%. I'm just going to wait and see. So it'll be interesting to see how that affects markets when they do get more volatile. Is there money coming in off the sidelines, or are they going to kind of stick with grinding it out in these short-term instruments until valuations become more compelling for them to then go out and earn that equity risk premium?
Yep. I mean, I think generally when we talk internally, look, do we expect you to be able to earn, let's just say, roughly 5% on a 6-month Treasury forever? No. But while the opportunity is there, to your point, I do think it makes the calculus between the risk premium in equities and clipping coupons at 4 to 5% a little bit more compelling. Let's get into performance in the quarter, but you also highlight in the letter, on a rolling 12-month basis here through 3/31/23, international markets have added comparatively to U.S. large cap and even small and mid cap value, right? And we've been talking about this for a while, right? That I don't know, you know this better than I do, but the decade and a half kind of outperformance U.S. versus international markets at some point it didn't have to, but a general thinking was that wasn't going to be the case forever. And 1 year does not make a trend, but it does seem like, and we've been saying it for a while, international does add value to a diversified portfolio, which is kind of some of our core tenets when we look to construct portfolios for clients.
Yeah, I think that we had been, I think, steadfast in saying that there was diversification to be had in your portfolio, and an opportunity, right, that international equities offered to investors. And I think there was always the valuation case, which is somewhat easy to make. And I think even sometimes I'm guilty of just looking at it and saying, well, shoot, these valuations, look, they're too easy to ignore. And I think valuations need a catalyst. And I think for international equities, there was I think the catalyst, the primary catalyst, in addition to the valuations, right? Because the valuations were kind of trending for the better part of 24 to 36 months. They were like in a 2 standard deviation cheap type zone where you see these valuation disparities less than 2.5% of the time, right? Because of the way that the distributions look, 5%, kind of 5% cut both ways, right? So 2.5% on the expensive end and 2.5% on the cheap end. And I think for us, when we looked at it, the valuations looked really good and really compelling in international, both developed and emerging, but they never re-rated. And I think that was frustrating for us because we kind of kept, we kept our allocation there, and it was underperforming. It was positive, right? But it was a drag on performance relative to large cap stocks, right? And as inflation peaked in June, right? We got that 9% reading in June of 2022. What happened thereafter was the strength of the dollar, right? If you just took the dollar and the basket of currencies that it's measured against, and think like the euro, the yen, the Aussie dollar, the New Zealand, the Kiwi dollar, those currencies, the dollar peaked at at a level of like 112, right? So if 100 is kind of the par value of that index, it got up to 112, and then it just started to roll over. So it hit this peak of 112 in September, and then it really started to roll over. And in the fourth quarter of 2022, you saw international developed was up 17%, emerging markets were up like 10, outperforming U.S. large, mid, small, right? The entire U.S. equity complex. And that outperformance continued in the first quarter in developed markets, in international developed markets. Emerging markets got off to a very hot start in January and February, and then kind of trailed off and have since started to take off a little bit in the first, call it 10 days of this new quarter. But I think that you have really good valuations and you have the dollar rolling over, which makes these international companies more competitive versus their U.S. peers. I think that combined with you're earning more in a dividend yield, right? The international stocks pay better dividend than their U.S. counterparts. And now you've got the start of investors saying, hey, this does look really good. And now there's a reason that it looks good. And we're not ever saying that we think international stocks should trade at parity with U.S. stocks from a valuation perspective. But we do think that they were trading kind of historically cheap and kind of maintaining this allocation, not knowing when it's going to turn, but wanting to be there when it did turn. I think that it's been good to see. And like to your point, I mean, it's 1 year after a pretty good kind of 13, 14 year run for U.S. equities versus their international counterparts. But I think you're starting to see, certainly starting to see some benefits to that diversification, especially when you consider the tightening that's going on in the U.S. economy via the Federal Reserve's interest rate policy.
Well, with that, let's bring it back to the U.S. So, and you noted in the letter through the January, February, U.S. mid-cap and U.S. small-cap outperforming large-cap. We get into March, Silicon Valley Bank, Signature Bank in Manhattan, First Republic teetering in California, and kind of things snap back and you end the quarter with, large-cap outperforming. So give us a little bit more there in terms of your observations and your takeaways in terms of, January, February to March. And again, I don't want to get too focused on one quarter's worth of returns, but a lot did happen.
Yeah, I think that, well, first, when you talk about the regional banks, so Silicon Valley Bank, obviously publicly traded, First Republic, publicly traded. A lot of these, smaller banks are either small or mid-cap stocks. So kind of by definition, right, they're going to weigh down. The regional bank index, I think, was down about 25% for the quarter. So that's certainly weighed on indexes on a relative basis, right? If you're just, if you're looking to flight to quality, right, you're going to sell small and mid indexes, move into large cap. And then I also think what happened because of the turmoil in the banking sector, there's a segment of the market that believes that the Fed is going to pause, right? They're going to stop raising interest rates. That's when you hear people talk about the pause. That's what a pause means. They're going to stop raising interest rates, and then they're going to pivot. And the pivot that they're referring to is starting to cut interest rates, right? So they've spent the last 14 to 16 months raising rates, and the pivot that the market's suggesting is that they're going to start to cut rates, right? And the Fed and the voting members of the FOMC that determine this policy, along with Chairman of the Federal Reserve Jerome Powell, have been very steadfast. They want inflation at that 2% target. They feel like the employment is still stubbornly strong. The economic growth is still very good. It gives them the flexibility to continue to raise rates, right, to kind of combat this inflation. And so they're at this kind of dual, the Fed is saying one thing and the market's saying the other, right? The market's saying, not only do we think that you're going to pause, but you're going to start to cut rates, and you're probably going to cut rates more aggressively than you think. And what that caused the market positioning to do is to go with, well, what did well when interest rates were low and where monetary policy was more accommodated? Large cap growth stocks. And what recovered really well? Large cap growth. You're talking about the Apples, the Amazons, Microsoft, Tesla, these very high growth companies. As interest rates go down, the present value of those future cash flows that a lot of the market is using to analyze and to try to put a price on these stocks, the present value of those future cash flows goes up when interest rates go down. And when the interest rates have been going up, one of the reasons that tech broadly, right? And I think that there's certainly the blue chip tech stocks that we talked about, the Microsoft, Apple, Amazon, that cohort, they did better than some of the explosive growth, the recent IPOs, the venture capital darlings that went public that have less robust balance sheets, maybe are growing at a higher clip but are less profitable. what happened in March was, unprofitable tech, mega cap tech, it rallied because the market is saying the Fed's going to pivot, and not only pause, but they're going to pivot, and that caused large cap to really ramp up at the expense of mid cap and small cap, which I think were broadly weighed down by just the exposure to the regional banks, and maybe less of an exposure to information technology stocks as a sector basis. I think that large caps have 30 or 40% more exposure to information technology as a sector than small cap does. So disproportionately, if you believe that the rates are going to go down or going to decline, large cap stocks are going to do better. So I think it'll be very interesting, as you point out, to really watch and see, is the market right in their positioning, or is the Fed going to follow through, continue to raise rates, and when they've kind of got the base rate high enough, pause, but not just pause and then pivot, just kind of keep rates higher for longer, I think would suggest a little bit tougher sledding for some of those large cap stocks.
So let's maybe make that the final point here, and maybe just a refresher for the audience. So the Federal Reserve has a dual mandate, right? Price stability and full employment. Employment thus far appears to be in very good shape, maybe even stubbornly so, right? Unemployment still at 3.5%. So the price stability, right? So the inflation still running far above 2%, right? So that's the Federal Reserve's main focus. We've kind of talked about it before that, we went back and had a history lesson in the 1970s, where let's not say the inflation battle has been won until it's actually proven out, right? And avoid the prolonged fight against inflation that we saw in the 70s. So maybe, Jason, I'm not asking for a near-term call, because as you highlight, we're not near-term investors, but ultimately you frame the question, who do you believe, right? Either the markets and they think the Federal Reserve is going to blink and claim victory, or reframe the goal, right? That 2% is no longer the goal. Do they move it to 3? So who do you believe?
I mean, the adage that prevailed the last 10 years was like, don't fight the Fed, right? And I think that goes to kind of, there is no alternative that we talked about earlier. Kind of this idea that you don't want to fight the Fed. I'm going to take the Fed at their word, and they're going to keep it higher for longer. I think that you have to take them at their word for it, and I think despite the market, pricing it in, I think that you certainly, I think you until they really start to signal that they're not only willing to pause but then pivot, and maybe they pause. I haven't seen any indication that they're going to pivot. It's not to say that they can't. But I think it puts investors, and this is kind of how I end the letter, right? It's that it puts investors in this dilemma, right? Where is the market positioning right, or is the Fed and the voting members of the FOMC right? And to your point, I mean, we don't really, that's going to sort itself out. We don't have a crystal ball. And I just drew the analogy to what my father did when he was coaching us, and he would constantly be preaching if we were in a tight game. He would say, no peaks, no valleys. And then he would stick his arm out like this, right? And I think what he was trying to say to us was just, you can't be a prisoner of the moment, right? You can't be the highest of highs or the lowest of lows. You need to be even keeled, right? You need to really accept the fact that you can control what you can control. And no matter how this thing plays out, or there's 1 minute, 1 minute the market's going up, the next minute the market looks like it's going to collapse. I think there's this idea that you really just need to approach this in a sober fashion and very kind of an irrational way. And we identify kind of 3 levers that you can pull on, right? This idea of no peaks, no valleys. The first one is diversification is your friend. You want to own stocks, bonds, real assets, which is something that we've been pounding the table on, for the better part of 3-4 years, that should be a part of your diversified portfolio. That's going to help you. That's going to help you weather this storm, because bonds are actually doing their job, right? Last year they were down double digits. This year they're up, anywhere between 1.5% to 3%, depending on what kind of bond you own. But they're doing their job. Markets are volatile. They've been positive, right? They've been that ballast. They've been sturdy, right? So diversification is your friend. The second thing is what we opened up with. Make sure your cash is earning make sure your cash is earning a reasonable reasonable rate of return, there is an opportunity cost to not paying attention to your cash. Make sure that it's earning it. And I think the third thing that's going to get you through this is just making sure that you're up to speed on what your goals and objectives are. Have they changed? Are you communicating that change to your advisor? Right? It's this idea of this two-way relationship that really adds value. Right? In a year like 2019, when the market's ripping and it's going straight up, there's a sense that, oh, well, it's great, I don't need to talk about it, right? 2021, kind of the same thing. But when markets are more volatile, and we think they're going to be more volatile for longer, right? We think the Fed's taking back the punch bowl, and the idea that it's going to go to 0% interest rate policy, like, those days are done. So we're going to have more volatility, which means you need to be more actively engaged with your advisor so that everything is where it kind of needs to be. And I've had several conversations with clients, and they say, I've gotten through this, I feel good about where I'm at, and I want to keep my portfolio the same way. I've had clients say, I feel like my financial plan's been tested, it's had resolve, I can actually get more aggressive. And I've also had clients say, well, you know what, I can earn 5% in cash. Let's take maybe X amount out of equities, move it into fixed income. I'll just feel better about it, right? I think all of those conversations are productive. I don't think that there's a right or wrong answer. It's just that these are the kind of things that are going to help get you through, right? The idea that no peaks, no valleys. Well, the way that you can achieve that in investing is having this healthy dialogue with your advisor, with the people that know your plan really well and know your situation really well. I think those are the things you have to lean on in times like this where recession's looming. What's the Fed going to do? There's the debt ceiling. There are all these variables that are out there, Dave. To your point earlier, which you kicked it off, there's going to be this. There's always something to talk about in these updates. I think you got to lean on those three things and get through it together, right? The relationships that you have with your advisors, I think that's what's going to help get you through these difficult times, because there's no silver bullet. There's not one investment out there that we can put clients in that's going to solve all their problems and going to help them sleep better at night. Like, it's just not out there. And when you accept that, then you go to this, which is the healthy dialogue that I think you have espoused on this for, as long as we've been doing that, right? That good client-advisor relationship.
Well, and when you were going through those client examples, what I wrote down was, look, there is no wrong answer. It's a client-specific decision. And, hopefully clients know this at this point, but don't hesitate to reach out to us, or we should be reaching out to you, because I think you want to always understand your portfolio, but you definitely want to understand your portfolio in times of uncertainty, or we just need to double back on the longer term plan. I think all of those things are always important, but definitely in a period where we expect markets will continue to bounce around until we get more and more clarity around price stability and inflation. And until that happens, I don't disagree with you that I think volatility is going to remain, let alone the issues we highlighted beyond inflation.
Yeah, and I think it's a great time. Markets are up. They've recovered from a pretty difficult 2022. You've got 2 quarters now where most major equity indices were positive. It's a great time to do a little spring cleaning, if you will, and just check in and make sure that everything is where it needs to be. Because you're right. There's no right or wrong answer as a broad as a broad statement, right? Because each individual portfolio, each individual financial plan is unique, and it should be unique, right? I think that's the one thing that, if you take nothing else out of this, is that your portfolio and your plan are unique to you, and how you react to these situations and these events are is something that your advisor can help you out with. And we can do these tweaks, right? Because we're not running, I think at Schneider Downs, right? That's like our value proposition to our clients, is that we're not out there running these giant models that everybody looks the same, everybody gets the same investments, gets the same advice, right? they get the. I think that's where you can kind of get in trouble, where there's blanket answers. So.
Well, I think that was well stated, and I think that puts a wrap on this quarter's communication. Obviously, I think we've done a nice job, and we'll continue to put out content as things continue to evolve and try and provide the audience our opinion in real time. But obviously, please don't hesitate to reach out to us as well if you'd like to have a conversation.
Yeah, I agree. Thanks, Dave, for taking the time. Look forward to getting back together with you next quarter.